The CPI numbers for April came out last week, and it looks like essentially what has happened is that it's lower than what it was, but it's higher than what we expected. There's a lot of talk that a peak might be in. Do you think that this is the case? And if so, what does this mean for yields and markets?
Yeah, so I definitely think we are at peak inflation. We talked about this before. The reason we're at peak inflation has a lot to do with base effects. So the year ago comparison's getting a lot tougher. Throughout 2021 and in the early parts of 2022, we were lapping against inflation a year ago that was basically sub 2% consistently and regularly. Now that we're getting into the second quarter of 22, as we go into summer and we get into the back half of the year, we're going to be lapping against 4%, 5%, 6%, 7% inflation numbers. So it's much harder to put up a red hot year over year inflation rate when the year over year rate a year ago was, very, very high. So there are some base effects in there. That's why you're seeing some deceleration in headline inflation. That's why a lot of people think we've reached peak inflation. I'm one of those people. But that's not all that significant, right?
Mm-hmm.
Because if inflation is decelerating simply because of base effects, that doesn't really mean that inflation at its core, in its true sense, is hurting everyday Americans less and less.
Mm-hmm.
So what you want to see actually is deceleration in the month-over-month rates. You want to start seeing inflation decelerate from March to April to May to June. You want to see those inflation rates decrease and go down over time. You are starting to see semblances of that, but not in a way that I think a lot of people wanted to see.
Mm-hmm.
So is inflation decelerating? Yes. Has inflation peaked? Yes. Does that mean inflation is going to go away anytime soon? Probably not.
Mm-hmm.
That what the April CPI numbers told me is we're at peak inflation and we're on the other side of this hill, but this is not a steep hill. This is a very gradual hill, and it's going to be a painstakingly slow process to get back to, roughly 2% inflation rates. All right, is that accomplishable by the end of the year? Probably not. Is it accomplishable by the end of 23? Probably. So I think we won't normalize inflation. We won't get back to a normal inflation rate until late 23. So you're talking another 16, 18, maybe even 20 months. So peak inflation, yes. Decelerating inflation, yes. Still got a long ways to go to fight this battle. What does it mean for markets? Well, you're seeing the 10-year Treasury yield start to top off, right? We had this massive shoot from 1.5% to 3% in a matter of months. We hit our head on 3%. We went a little bit above it, got to around 3.1. Ever since then, we've cooled off, and we've been range bound on the 10-year from about 2.8 to 3, kind of bouncing between those levels. So long as there's stability there, which I believe there should be given the decelerating inflation trend, so long as you get stabilization in the 10-year from 2.8 to 3, that should provide valuation support for stocks to head higher on the assumption that earnings remain strong. So that's why we're starting to get pretty constructive about recent price action. Not out of the woods, not at all, but the near-term outlook is definitely improving thanks to peaking inflation and stabilizing yields.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.